Hello everyone, welcome to EduTap and welcome to Finance 360-degree session. So in today's session, we are going to discuss two very important articles, okay? So first, we are going to discuss about the credit risk management, okay? So these are the two articles that we have to discuss. The first article is regarding the credit risk management, second amendment. So what is the amendment that has happened? What are the changes that have been brought? What points you have to remember from the examination perspective? This is what we are going to discuss, okay? The second news article is regarding the RBI's amendment directions on the investment fluctuation reserve. So this we are going to discuss, as well as there is also another MOU that has been signed by India. So what is this MOU and who is the partner of this MOU? How the UPI is related to this? So recently this MOU has been signed, so that we are going to discuss. So actually three articles we will discuss in today's Finance 360-degree session. So good morning everyone. So let's start with the first part, and then we will discuss the second article, then we will discuss about the MOU, and then at last there is also a big announcement for all of you, okay, that we will discuss. Now, as I know that the exam is very near, only you have a few days left, so we will not delve too much deep in the topics. I will just provide you the broad understanding, and I will provide you the important data points, okay? Now let's get started with the first article, that is Reserve Bank of India Commercial Banks Credit Risk Management Second Amendment Directions 2026. First of all, I hope I'm clearly audible and the screen is visible. Okay, everything seems fine. So the Reserve Bank of India has issued the Commercial Banks Credit Risk Management Directions 2025 to strengthen the credit risk management in commercial banks through prudential norms, board-approved policies, and effective monitoring of credit exposures. Okay. So basically, these directions are released for the commercial banks. Now, the enforcement of these directions are from 1st April 2027. Now, determination of rating in case of country risk. See, first, what happens that first, there is the whole article that is divided into two parts. One is regarding the country risk and the other one is regarding the unhedged foreign currency exposure. Okay, so this particular article is divided into two parts. So this country risk, we have already discussed this in a marathon session, in the weekend marathon session also, that there can be country risk. Let's say the banks, they are investing in the different instruments of another country, let's say Zimbabwe or Uganda, or let's say the banks are investing in the securities of different countries of Singapore. Okay, so a particular country has, like let's say Zimbabwe has more risk in comparison to the instruments of Singapore or UAE. So basically, different countries have different risk, as well as different country products have different risk. Now, usually the international credit rating agencies or the credit rating agencies of a particular country, they provide the rating for their own products, Now, it has been said by the Reserve Bank of India that do not blindly trust on the international credit rating agencies, do not blindly trust on the ratings provided by the other countries. The bank should have the internal processes to identify the risk with the associated exposure that the banks have. Okay? So if the banks are providing loans to the entities in Zimbabwe, if the banks are investing in the securities, in the debt instruments, in the shares of the companies of Zimbabwe, so bank has to have the internal processes for identifying the risk related to a particular country and investment in that particular country. Okay, so a bank shall put in place appropriate system to move over to internal assessment of country risk. So there should be internal assessment of a country risk and shall evolve sound systems for measuring and monitoring the country risk. A bank shall not rely solely on the rating agencies or other external sources as their only country risk monitoring tool. However, the rating accorded by a bank to any country shall not be better than the rating of that country by the international rating agency. So bank should provide the internal rating basically for the exposures to a particular country, but the internal rating cannot be higher than the international credit rating that is provided. That is the broad idea. Until banks develop their own internal systems, the banks can use the country risk classification system of which entity? So basically, until banks develop their own internal system for assessing and monitoring the country risk, identifying the country risk, that is for the exposures that the banks have for the instruments from a particular country, they may use the 7 category country risk classification system followed by ECGC. Okay? These classification help banks in evaluating the level of risk associated with lending to the companies or corporations of a particular country or having exposure in the different countries, and also help them determine the amount of provisions or safety buffers that should be maintained against possible losses arising. So if the banks are able to identify the risk, they will be able to maintain the provisions against those risks also. So this is the idea that till such time banks move over to the internal rating system, a bank may use the 7 category classification followed by the ECGC. ECGC shall provide to the bank on request quarterly updates of their country classification and shall also inform all banks in case of any sudden major change in country classification in the interim period. So this is the whole idea. Now moving forward, the frequency of periodic reviews of country risk rating shall be at least once a year. Now next is capital requirement for unhedged foreign currency exposure. Let's say that the bank is giving loan to an exporter. Okay, so bank has given loan to an exporter. This can be pre-shipment loan also or post-shipment loan also. So basically the bank has given credit, to the exporter. Now let's say the exporter is importing. Let's say the ABC Limited, it is the exporter. Okay, it is the exporter of India. It is importing machinery from US. Now for the machinery that is imported from US, the payment is due after 2 months. So let's say there is the import, a big machinery has been imported. This is the big machinery that has been imported by the ABC Limited, and the US based company has given 2-month time for the ABC Limited to pay the funds, to pay the money. Okay, now this machinery is of $10 million. That means right now $1 is equal to 80 rupees. So 80 million rupees. This machinery is worth 80 million rupees. Okay. Now expected payment today is 800 million rupees. Sorry, 800 million rupees. So the expected payment today is 800 million rupees. ABC Limited does not hedge this exposure. Let's just say that the ABC Limited is thinking that okay, after 2 months the ABC Limited will pay the $10 million. That is around 800 million rupees, because the time is not very volatile and there is the rupee is not depreciating much. Let's say the rupee has started depreciating in the past 2-3 months very fast manner. Before that, rupee was not depreciating as much. So let's say the ABC Limited is in the before era where the rupee was not depreciating much, and the ABC Limited is thinking that why take the contract, why do the forward contract? Because in the forward contract, let's say the rate is decided at $1 equal to 85 rupees. So the bank, basically the ABC Limited is thinking that why I pay 85 rupees for $1. When right now the rate is $1 equal to 80 rupees, it will go 81 rupees, 82 rupees maximum. So ABC Limited is not hedging the exposure, is not reducing the risk with the exchange rate fluctuations. Okay, after 2 months the rupee actually depreciates to 90 rupee against $1. So now $1 is equal to 90 rupees. That means the exporter, the ABC Limited, which has imported the machinery, has to actually pay $10 million at 90 rupees for per dollar. That is 900 millions. So the loss due to currency movement is 100 million. So this USD liability was unhedged foreign currency exposure. So this is the unhedged foreign currency exposure which has not been hedged. Okay, in practice many companies choose not to fully hedge because hedging has a cost. The forward contracts, they have a cost of the contract, as well as the margin has to be paid. Usually the rate is at the higher level. Okay, because right now if the rate is $1 equal to 80 rupees, then the contract rate can be 85 rupees, 87 rupees, 84 rupees or something. So many of the people entities that have the exposure, they might think that why have the contracts which have the cost. Okay, or they, even after having the contracts, they only partially hedge their exposure. So this is the basic idea. So bank, now what has happened, that the exporter had to pay $800 million. The exporter that has imported the machine, the exporter which has imported the machine, basically had to pay 800 million rupees. But now he has to pay 900 million rupees. That is 100 million rupees extra. So this exporter is under the loss case. There is loss that has happened. Now some of the exporters will be able to handle this kind of loss because they are dealing in huge amounts. But other exporters can be under huge risk also. Okay? So now it has been said to the banks that banks are providing the loans to the exporters or to the entities that are having the unhedged foreign currency exposure. And if the banks see that some of the exporters, some of the entities, if they are having the unhedged foreign currency exposure, then the banks have to maintain capital against the higher risk weight asset. Okay? So basically, if the bank sees that a loan has been provided by the bank, the Indian bank has provided the loan to some exporter of India or to some entity of India that has unhedged foreign currency exposure. And in the future, the losses can happen to this exporter or this entity. Maybe the loss will not happen because the dollar do not appreciate so much or rupee do not appreciate too much, but there is unhedged foreign currency exposure, and yes, the loss can happen. This is the truth. Loss can happen because there is the unhedged foreign currency exposure. If the rupee depreciate, loss can happen. Okay, so Indian bank has provided loan. Now because the exporter or the entity has unhedged foreign currency exposure, so in this case the risk weight will be increased for such kind of exporter or entity in certain cases, because the exporter or the entity has the unhedged foreign currency exposure, due to which the entity can come under the loss and the risk weight of the entity can increase. Okay, risk weight of the entity can increase for the bank, because if the entity is under the loss, the entity might not be able to return the loan taken from the bank. The entity might not be able to make repayments to the bank. So the risk weight of the entity will be increased. This is the basic idea. Okay. So here a bank should assess and monitor the unhedged foreign currency exposure of the entities to which the bank has given the loan, and these entities have unhedged foreign currency exposure. A bank shall ascertain the foreign currency exposure of all entities at least on an annual basis. To ascertain the foreign currency exposure, a bank shall consider the items maturing or having cash flows over the period of next 5 years. A bank shall assess, like after seeing the foreign currency exposure, the bank will see that okay, this foreign currency exposure is naturally hedged, or the foreign currency exposure is financially hedged. Okay, so foreign currency exposure, if an entity has the foreign currency exposure, maybe the entity has already taken the financial hedge. That means the entity has already come into the forward contract to reduce its exposure, to reduce its foreign currency exposure. Or let's say the entity has the natural hedge. Entity has to pay $10 million after 2 months. Now the entity that is the exporter has a contract that it will get $100 million. It will, for its exports, it will get $100 million after 2 months. That means its exposure is covered. If it has to pay $10 million, but it will be getting $100 million. So its exposure is already hedged through its transactions, through its business. Okay, so that is a natural hedge. That is a natural hedge, that in your business itself your exposure has been hedged. So bank shall assess. Now after seeing the foreign currency exposure, the natural hedge, the financial hedge, the bank shall assess the unhedged foreign currency exposure. Okay, so bank will assess that how much is the unhedged foreign currency exposure, and once the unhedged foreign currency exposure is identified, a bank shall determine the potential loss that can come to the entity from such unhedged foreign currency exposure using the largest annual volatility in the US dollars INR exchange rate during the last 10 years. So in the last 10 years, what was the largest volatility in the dollars and rupees? So according to that volatility, according to that depreciation of rupees, the unhedged foreign currency exposure will be taken for the loss, that how much loss will happen. Okay, so in the above case, the loss is 100 million rupees. So this is the basic idea, that banks, after recognizing the unhedged foreign currency exposure of the borrower, basically the exporter or the entity, the bank will identify that how much will be the potential loss because of this unhedged foreign currency exposure. Now this potential loss, if it is very small, if the potential loss is up to 15% of the earnings before interest and depreciation of the entity, that means potential loss is only up to 15% of the total earnings before interest and depreciation. That means the company has enough of the earnings to handle the loss as well as to pay the payments or repayment to the bank. More than 15%, up to 30%, more than 30%, 50%, more than 50%, 75%, till the potential loss is up to 75% of the earnings before interest and debt. So the potential loss is up to 75% of the earnings of the company. Till then, it is said that there is no need to increase the risk weight. There is no need to increase the risk weight of the loan. That means there is no need to maintain higher capital for the loan. But as soon as the potential loss become more than 75%, potential loss become more than 75% of the earnings of the company before interest and debt. So the potential loss that will happen because of the unhedged foreign currency exposure, the potential loss that is expected is more than 75% of the earning of the company. Then the risk weight has to be increased by, anyone knows, the risk weight has to be increased by 25 percentage points. If the risk weight is increasing against the risk weighted asset, against the risk weighted loans, the banks have to maintain the capital. So against the risk weighted asset, if the risk weight is increasing for the loan, that means at the higher risk weight there is higher capital that has to be maintained. Okay, against the higher risk weight there is higher capital that has to be maintained. So this is the idea. So if the potential loss due to the unhedged foreign currency exposure is more than 75% of the earnings before interest and depreciation, in this particular case the risk weight will increase by 25 percentage points. The risk weight will increase by 25 percentage points, and against the higher risk weight, higher capital has to be maintained by the banks. So this is the idea. If the potential loss is more than 75% against the earnings, 25 percentage point increase in the risk weight will be there. So entities' earnings before interest and depreciation over the last 4 quarters is seen according to the statutory updates. Incremental capital requirement. So as I have told you, see, let's say for this particular loan, the bank has given loan to the exporter. For this particular loan, the bank is identifying that the risk weight is 50%. The risk weight is 50% because all the different loans, they have certain risk weight. Okay, if the loan is given to the central government, then in this case the risk weight is taken at 0%. But if the loan is given to different corporates, the micro, small and medium enterprises, so they will have different risk weight. The corporates, let's say, have risk weight of 20% or 50% or 100%. MSMEs have the risk weight of 50%, 100% or something. So here the bank has given the loan to the exporter that has the risk weight of 50%. Now, if the exporter has unhedged foreign currency exposure, and this unhedged foreign currency exposure can lead to the potential loss of more than 75% against the earnings before interest and depreciation of this exporter. So in this case, if the potential loss is more than 75%, then the additional risk weight of what percentage has to be maintained? The additional risk weight of 25% has to be maintained. So this is the idea, that this 25%, this more than, if the potential loss is more than 75%, so additional risk weight of 25% has to be maintained. Okay, so incremental capital requirement shall be over and above the existing risk weight. So if the existing risk weight is 50%, the 25% additional risk weight should be over and above this 50%. So the risk weight will become 50% according to the existing regulation plus 25% as due to the potential loss because of the unhedged foreign currency exposure. So in total, the risk weight will become 75%. Okay. So incremental capital requirement, as an example, for the 25% risk weight, increase in the risk weight will increase to 75%. If the older risk weight was 50%. The incremental capital requirement against the higher risk weight, higher capital has to be maintained. So this shall be based on the total exposure. So the risk weight will be on the total exposure, total loan. The capital that has to be maintained should also be against the total exposure. A bank shall calculate the incremental capital requirement at a minimum on a quarterly basis. And for projects under implementation or for the new entities which do not have the audited reports of the earnings before interest and depreciation of the last 4 quarters. So in this case, for projects under implementation or for new entities, a bank shall calculate the incremental capital requirement based on the projected expected average annual EBIT for the 3 years from the date of commencement of commercial operations. Okay, so expected average annual or projected average annual EBIT has to be taken for the 3-year time period. Now, in case where the bank has identified the unhedged foreign currency exposure, so bank has identified the unhedged foreign currency exposure of an entity to which the loan has been given, but it is very difficult for the bank to identify the potential loss. In this case, if the potential loss is not being identified by the bank has to increase the risk weight to 25 percentage point. So in case where the bank is not able to get sufficient data to assess the unhedged foreign currency exposure or to assess the potential loss, in this case, the bank has to take the conservative view and keep the risk weight or increase the risk weight by 25 percentage point. Okay. Now coming to the next article, that is the RBI's amendment directions on investment fluctuation reserve. So basically, see the banks. Any confusion in the first article? Now coming to the next article, that is regarding the investment fluctuation reserve. The investment fluctuation reserve. Okay. See the banks, if they are investing in the debt securities, let's say they are purchasing the central bank or central government securities, the dated securities of 10 years, 15 years, 3 years or something. They are also purchasing the corporate bonds. They are also investing in the state government securities, the state government bonds, in the municipal bonds maybe, or they are investing in the equity also. The banks are also investing their money in the shares, in the mutual fund, in the ETFs, that is the exchange traded funds and such. So banks are having multiple exposures. Now some of this investment the bank has done. Now bank can do the investment under held till maturity, under the available for sale. First, let's understand these two. Held till maturity means that if the bank has invested in this particular instrument, the bank will hold on to this till maturity. So held till maturity usually consists of the debt securities. Okay. Now why the bank is keeping the held till maturity instruments? Because these instruments will provide the regular flow of returns, like the debt securities, the central government securities, the state government securities, which are held till maturity. They are providing the regular flow of returns, the regular interest the bank will be getting. So this will become the regular income for the bank. Okay. Now this security the bank is going to hold till maturity. The bank is not going to sell it in the market. Available for sale basically has the flexibility. If the bank wants, the bank can hold the security till maturity. But if the bank is not able to hold the security till maturity, the bank can also sell it in between. So available for sale is basically the securities. This also consists of the debt securities that can be held by the bank, or the bank has the freedom to sell it also. Okay. So this is the idea. First of all, a bank shall classify securities under held till maturity only after these conditions are met. Only after these conditions are met. That is, the security is acquired with the intention of holding it till maturity. So held till maturity, these are the debt securities, or these are the instruments that have to be held till maturity. So this is the financial asset that is held till maturity, and this is the financial asset. This is the debt securities or the debt instruments or the other instruments that are held with the bank with the objective to collect the contractual cash flows, to collect the interest, to collect the returns on the regular basis, on the half-yearly basis or on the quarterly basis and such. The contractual terms of the security give rise. So as per the contractual terms, as per the contract, as per the document, there is the regular cash flows that have to be given to the bank, okay, for the interest payments or solely payments of principal and interest. This is the idea. So held till maturity consists of the debt securities that has to be held till maturity by the bank. Okay. Available for sale, here the flexibility is there. It is under this available for sale, the debt instruments are included. Now the bank can hold this for collecting the contractual cash flow, or in the case of immediate liquidity requirement, the bank can also sell such securities. So available for sale security shall include debt securities that meet the SPPI criteria, that is the solely payments of principal and interest on principal outstanding, that is there is the regular payments that are coming, the regular interest or the cash flow that is coming. Where the bank's intent is flexible, the bank can hold this till maturity or sell it also. So there is no binding regulation that the bank has to hold these securities. If it is under available for sale, the bank can hold it or sell it also. This consists of the debt securities, but here there is a clause that provided that on initial recognition, as soon as the bank has purchased the equity, the shares, if the bank want to keep it under available for sale, the bank can keep it under the available for sale. But the bank has to, in the initial recognition only, the bank has to inform that this particular shares the bank is keeping under available for sale. Okay. So usually available for sale consists of the debt securities, which provides regular income to the bank, which provides regular returns to the bank, and the bank can hold this debt securities or can sell this debt security in the market also. Another thing is that the equity, that is the shares, can be, certain equity can be included in available for sale, with the criteria specifically saying that at the initial recognition only, this equity should be kept under available for sale. Okay, it's not like that you are keeping it in some other category, then you are bringing it here. Okay. Next is fair value through profit and loss. Whatever does not be included in STM or AFS, that is included in fair value through profit and loss. So equity shares, any equity share, any shares can come under fair value through profit and loss. Investment in mutual fund, alternative investment fund, real estate investment fund, infrastructure investment trust, that can come under fair value through profit and loss. Investment in securitization notes, bonds, debentures, where the payment is linked to the movement in particular index rather than the interest rate benchmark. If the bond and debentures, they are linked with some particular index, other index, that can also come under fair value through profit and loss. Okay. Under the fair value through profit and loss, there is the held for for trading. Held for trading, basically by the name itself you can understand that these are the shares, these are the instruments that are held for trading, like short term resale or profit from short term price movements and such. And these held for trading, there is no legal impediment against selling or fully hedging it. A bank shall fair value daily all HFT instruments, because held for trading is for trading. So as per the market fluctuations, the price also can change on the daily basis. That has to be identified by the bank. So basically we have understood that the bank investment is divided into different categories, that is held till maturity, available for sale, and fair value through profit and loss, under which there is the held till held for trading, held for trading. Okay. So under the FVTPL, there is held for trading, that is purely for the trading. There are certain instruments that have been bought. Now, held till maturity, will it depend upon the market fluctuations? Now, in the contract, it has been clearly written that this is the interest that will be paid. 10% is the interest that will be paid on the per annum basis, and this debt instrument is for 10 years. So the bank will have to hold this debt instrument for 10 years. Will there be any changes in the price of the bond? Will there be any changes here? No. The interest the bank will get on the regular basis, or the bank will get these flows, as well as the bank will get after maturity. If the bank had invested 100 crore rupees in this instrument, the bank will get this much amount when the maturity happens. So in the held till maturity, it is not getting it is not having any fluctuation in the as per the market prices. As per the market prices, there are no fluctuations in the held till maturity. Even if, see, whenever the interest rate increases, the bond price decreases. Whenever the interest rate in the market is increasing, the bond prices decrease. So this is a basic norm that happens, that if the interest rate is increasing, the bond prices decrease. If the yield is increasing, that means the bond prices are decreasing. This normally happens. Okay. So if the interest rate increases in the market, will the bond price that is the investment that is done of 100 crores by the bank in held till maturity, will it be affected? No, because the bank will keep on holding the instrument for 10 years, and after 10 years the bank will get this 100 crores. So even if in the market right now the bond prices are fluctuating, doesn't matter. For available for sale, now in this case, yes, because let's say the bank has bought this debt instrument for 100 crores. Okay, this debt instrument has the value of 100 crores. If in the market the interest rate is increasing and the bond prices are falling, so maybe the bank, if it has to get the liquidity, the bank may sell this debt instrument immediately at lower price of 95 crore. So yes, the bank can face certain loss, and the fluctuation can affect the bank also. The fluctuation can affect the bank also. Okay, because this bond has to be sold in the market for 95 crores rather than 100 crores that the bank invested initially. So the available for sale, the bank might have to sell the security because of the liquidity concerns. So in this case, if the bond prices are fluctuating in the market, so it might affect the bank also. Held for trading, like these are the instruments that are actually for trading, that are actually taken at fair value, that are actually taken like for the trading purposes and such. So yes, they also fluctuate according to the market conditions. So basically, till now there was the investment fluctuation reserve. In this investment fluctuation reserve, if there are any fluctuations that are coming in the market, according to that, the reserves had to be maintained to cover the losses for the available for sale, because if the bank had bought the security for 100 crore, the bank has to sell the security at 95 crore. So the bank is facing a loss, even though bank earned the interest for certain time period, but now the bank is facing the loss of 5 crores. Okay, for the held for trading, if certain like let's say the equity, the shares were purchased, or the mutual fund units were purchased, now because of the market fluctuations, the bank shares value is decreasing, the mutual fund units value is decreasing, so bank might have to sell it immediately, because this is the shares or the mutual fund units that were for trading. So the bank might face loss here also. So to cover these losses that can come in the available for sale and held for trading, so in these cases, in the FVTPL, including the held for trading, so whatever losses can come, that could be covered through the investment fluctuation reserve. So basically, this was the idea that banks invest in government securities and bonds whose price can change with interest rate. So if the interest rate is increasing in the market, the bond prices will fall. When interest rate rise, bond prices generally fall. This can reduce the value of the investment portfolio of banks and lead to losses for the banks. But for the held till maturity, here, even if the bond prices are decreasing in the market, it doesn't matter for the bank, because the bank will get on maturity the 100 crore rupees, and the bank is not affected by the market conditions for the instruments that is held till maturity. They are kept till maturity, and the government or the corporate will pay back at maturity to protect bank from losses. Now, but for available for sale, for FVTPL, including the held till maturity, for these kind of instruments that could be sold in the market, and in the market, according to the market conditions, the losses can happen. So to protect the banks from losses, RBI mandated the investment fluctuation reserve, a reserve built from profits earned on selling investments. Now we will understand this. Okay, so basically, now what is the changes that have been brought? What are the amendments that have been brought? Correct, Pramod. So for commercial banks and local area banks, for these category of banks, it has been said that there is no need to maintain the IFR any longer. So there is no need to maintain the investment fluctuation reserve. Why is it so? Because see, it is said that commercial banks are already keeping against their risk weighted assets. So let's say the asset, that is the investment that the bank has done. The loans are the asset for the bank, as well as the investment that the bank has done in the debt securities, in the debt instruments, in the different instruments that are also the asset for the bank. According to the risk weight, the bank is keeping capital. So for the market risk, that is for the fluctuations in the prices in the market, for the operational risk, for the credit risk, the bank is already seeing all the risk associated with the assets, and according to the risk weighted assets, the bank is keeping the capital. Okay, so it is said that the commercial banks and the local area banks, they do not need to maintain the investment fluctuation reserve, because if the loss happens because of the market risk, if the loss happens, the value of the securities start decreasing, that is kept in the available for sale or the FVTPL, held for trading. In these securities, if the market risk comes, if the fluctuation comes and the losses happen, that could be covered through the capital that is kept under the risk weighted assets, because risk was already recognized for the assets, for the securities, for the investment. The risk was already recognized and capital has been maintained by the commercial banks and the local area banks, so they do not need to maintain this investment fluctuation reserve also. Okay, any confusion here? First of all, got it? So commercial banks, following revised investment norms, will no longer maintain investment fluctuation reserve, because if any loss comes to the commercial bank, that can be covered through the capital kept against the risk weighted assets of the bank. This capital is kept for the market risk, to handle the market risk, credit risk, and the operational risk. This is the idea. So banks, seeing their market risk, capital risk, and the operational risk, the banks are already seeing the risk weighted assets. The bank are already seeing the risk associated with the different assets and are maintaining the capital to handle the losses. So they don't need to keep the investment fluctuation reserve. So existing IFR balances till now, till 17th of May 2026, whatever existing IFR balances have been kept. So till May 2026, like when the notification was released, till then whatever IFR balances were kept. So existing IFR balances will move to statutory reserve, general reserve, or profit and loss account. So till now, the commercial banks, local area banks, they were maintaining the investment fluctuation reserve. They were keeping some money in these reserves. So now they no longer need to maintain the IFR. So they can send the money to their statutory reserve, general reserve, or profit and loss account. For foreign banks operating in India through branches, RBI has clarified that when the IFR requirement is removed, the existing IFR balance cannot be taken out of India. So see, these regulations are applicable from 18th May 2026. So till 17th May, like from 18th May 2026, the commercial banks, local area banks, they do not need to maintain the IFR, the investment fluctuation reserve. So till 17th May, whatever fluctuation reserves they have maintained, the foreign banks operating in India through branches, RBI has clarified that when the IFR requirement is removed from 18th May 2026, the existing IFR balance cannot be taken out of India. Instead, it must be transferred to the bank's statutory reserve in Indian books or kept as remittable surplus that can be remitted to their parent, to their own country, but it is not right now repatriable so long as bank functions in India. So basically, for the commercial banks, for the local area banks, it has been said that from 18th May 2026, they no longer need to maintain the investment fluctuation reserve. Whatever investment fluctuation reserve they maintain till 17th May, that can be transferred towards statutory reserve, general reserve, or profit and loss account, or any of these account. For foreign banks operating in India through branches, so that is RBI has clarified that when the IFR requirement is removed from 18th May 2026, the existing IFR balance cannot be taken out of India, though it can be transferred to the bank's statutory reserve in Indian books or kept as remittable surplus retained in Indian books, which is not repatriable so long as the bank functions in India. But when the bank closes down, then it can take back the surplus. For small finance bank, regional rural banks, and payment banks, because these are the small banks or they are working in the different domains. So see, small finance bank, it provides the small loans. Regional rural banks, it is working in the rural areas. Payment bank, it also provides the banking services for the far off areas. So for these particular category of banks, it has been said that they still need to maintain the IFR. They still need to maintain the investment fluctuation reserve. A bank shall create the investment fluctuation reserve using, now from where the money will come in the investment fluctuation reserve. It has been said that the small finance banks, RRBs, and the payment bank, they have to maintain the investment fluctuation reserve. But in this reserve, from where the money will come to handle the losses, if any losses happen due to market risk. So basically, the reserves will come from the let's say sale of investment is happening. Some securities, the debt securities have been sold that were kept in available for sale or held for trading. So for held for trading or for available for sale, if there were any debt securities, if they have been sold, or equity or mutual fund units, if they have been sold, so bank has sold the investment, and for this investment the bank is getting the net profit. From that net profit from the investment, the money will be kept in the IFR. Okay, this is the idea. So basically, a bank shall create an investment fluctuation reserve using the actual or realized gains earned from selling the investments, provided it has availability of net profit. So bank must continue adding to its reserve. So in the investment fluctuation reserve, 2% of the available for sale and FVTPL, including held for trading investment folio. So 2% of the investment folio, 2% of the investment folio has to be kept in the IFR. So if the investment in the AFS plus FVTPL, including held for trading, so if let's say investment AFS 100 crores and FVTPL 200 crores, so against the 300 crores, 2%, that is 6 crore, has to be kept in the against the 300 crores of investment portfolio. Against the 300 crores of investment portfolio, 2%, that is 6 crores, have to be kept in the investment fluctuation reserve. And this 6 crore will come from where? From the, let's say, sale of investment is happening because the bank has some assets for trading, so bank is selling the investment also. So if there is net profit, from that net profit from the sale of investment, the money should be transferred to the IFR. Okay, if the profit is not there, then there is no need to transfer the money from the to the IFR, but whenever there is any net profit, from that the money has to be transferred to the IFR, so that the IFR can be 2% of the investment portfolio. Okay, this is the idea. Any confusion? So this minimum requirement of 2% shall be assessed annually based on the AFS and FVTPL, including HFT portfolio values of the balance sheet date. Transfer to IFR shall be made from net profit after mandatory appropriations have been done. Now, next is urban cooperative banks. So, for urban cooperative banks, the IFR requirement is at least 5% of its investment portfolio. So, for a small finance bank, for the RRBs, for the payment bank, the requirement was 2% of the investment portfolio in the AFS and the FETPL, including HFT. But for the urban cooperative banks, the IFR requirement is 5%, is at least 5%. The minimum requirement shall be assessed annually and shall be computed with reference to the book value of investments in HFT and AFS categories as of the balance sheet date. So basically, for the urban cooperative banks, it has been clearly laid down that 5% should be the minimum IFR against the investment portfolio, that is the investment in the held for trading and AFS categories. Urban cooperative bank may at its discretion build up higher percentage of IFR also, depending on the size and composition of its portfolio. So it can keep more than 5% of the investment fluctuation reserves also. A UCB may at its discretion can reduce the investment fluctuation reserve. Let's say the UCB is keeping 7% of the investment fluctuation reserve. So 5% is mandatory as per the RBI, but the rest of the 2%, the UCB was keeping additional investment fluctuation reserves to handle more of the losses. But now the RBI is saying that if the UCB wants, the UCB can draw down the balance available in IFR in excess of 5%, whatever is kept in excess of 5%, whatever, like 2% extra that is kept, or let's say 3% extra that is kept in the IFR accounts, that can be drawn down for credit to the balance of profit or loss, to provide more profits to the shareholders, to provide more dividend to the shareholders. So what is the minimum requirement for the UCB? What is the minimum requirement of the UCB for the investment fluctuation reserve? The minimum requirement of the investment fluctuation reserve is 5%. The UCB can maintain more than that also. And whenever the UCB wants, the UCB, if it is keeping higher reserves in the investment fluctuation reserve, so it can draw it down, but it should not go below 5%. It should not go below 5%. Okay, this is the idea. Any confusion? However, the minimum 5% reserve must continue to be maintained and cannot be withdrawn. Now, for a rural cooperative bank shall maintain IFR of not less than 5% of its investment portfolio classified under the current category. Okay? So, for the rural cooperative bank, it has been said that they have to maintain the IFR of not less than 5%, same as the urban cooperative bank. But here, it has been said that the investment portfolio, AFS or the HFT, has not been mentioned. Directly, it has been mentioned that investment portfolio classified under the current category. This minimum requirement shall be assessed annually, shall be computed with reference to the book value of its investment in the current category of the balance sheet date. So for the small finance bank, for the RRBs, for the payment bank, what is the minimum requirement of the investment fluctuation reserve? It is 2%. From where the money will come? The money will come from the net profit from the sale of investments. Okay? For the UCBs, what is the minimum requirement of investment fluctuation reserve from its investment portfolio? 5%. For the rural cooperative bank, 5% is the investment fluctuation reserve that has to be kept against the investment portfolio classified under the current category. Enforcement of the direction is from 18th May 2026. Okay? This is it. Now, here is the summary that is provided, that also you can see that foreign banks operating through branches in India and for the commercial banks and local area banks, there is no IFR requirement from 18th May. For small finance bank, RRBs, payment bank, 2% minimum IFR requirement. For UCBs, 2%, same provision applicable to the rural cooperative banks also. Now, revenue reserve created from profits. So revenue reserve, this is the reserve that the banks can have. This is created from profits. It excludes the capital reserve. It does not include provisions for depreciation, fall in asset value, replacement of assets, and known future liabilities. Okay. Now coming to the next article, here just I will provide you one line, that is the Reserve Bank of India has been actively pursuing interlinking of UPI with fast payment system of other countries, and the Reserve Bank of India has done a MOU. The Reserve Bank of India has done a MOU with Cambodia. So as part of this initiative, the connectivity of payment systems between India and Cambodia for acceptance. So there is the MOU that has been signed, or there is the launch of payment system connectivity between India and Cambodia. Okay. So basically, as part of this initiative, the RBI has been actively pursuing interlinking of UPI. The RBI has been actively pursuing the interlinking of UPI with the fast payment system of other jurisdiction to promote the cross-border payments. As part of this initiative, the connectivity of payment system between India and Cambodia has been initiated for acceptance of UPI at QR code enabled merchants in Cambodia. This has been launched on June 2nd, 2026 at Phnom Penh, Cambodia. This marks the go live of the first phase of collaboration between NPCI International Payments Limited, that is the NIPL, that is NPCI International Payments Limited, and the Ekleda Bank PLC. Ekleda Bank PLC under the aegis of RBI and National Bank of Cambodia. So as I've told you that under the aegis of RBI and the National Bank of Cambodia, the NIPL, that is national, the NIPL, that is NPCI International Payment Limited, and the Ekleda Bank PLC, they have come together for the payment system of India, that is the UPI, to be used in Cambodia for the QR code enabled merchants. Okay, this is the idea. So with this connectivity, Indian travelers visiting Cambodia can now make QR code payments to over 4.5 million merchants enabled with the national QR code of Cambodia using their UPI application. So this is the basic idea. Any confusion? So RBI has been actively pursuing the interlinking of UPI with fast payment system. As part of this initiative, the connectivity of payment system between India and Cambodia for acceptance of UPI at QR code enabled merchants in Cambodia has been launched. So our UPI can be used against the QR code enabled merchants in Cambodia. Now this marks the go live of the first phase of collaboration between the NPCI International Payment Limited, that is NIPL, of India NPCI, International Payment Limited of India, and Ekleda Bank PLC under the aegis of RBI and National Bank of Cambodia to enable interoperability of the QR code based person to merchant transactions between the two countries. So here the focus is on the person to merchant transactions, and the Indian travelers, they can use the UPI against the QR code of Cambodia, against the QR code of Cambodia. Okay? This is the idea. Now, the big announcement is that from 5th June onwards, there is the marathon sessions that are starting. So remember this, that today is your last Finance 360-degree session. Now, the Finance 360-degree sessions will not be taken till 13th, because now the marathon sessions are going to be started, and we want you to focus on the marathon sessions now. Okay, and we want you to attempt a lot of quiz. So if there is any article that is left, that will be covered through the marathon session. Like I know that there is a topic about capital charge that is not like that we had to cover in the Finance 360-degree session, but do not worry, through the marathon session we will focus on this topic also. Okay, so 5th June your first marathon is for the government schemes. Okay, then on 6th June you have the marathon session for RBI notifications and finance current affairs, and these marathon sessions are on YouTube, so remember this. Then 7th June you have the marathon session for ESI current affairs on YouTube. 8th June you have the marathon session for reports. 9th June you have the marathon session for GA, and 11th June you have the all current affairs marathon, Mahamarathon, for all current affairs for all of these. Remember 5, 6, 7, 8, 9 you have the marathon sessions from 5 p.m. to 8 p.m. from 5 p.m. to 8, 9 p.m. So this is the idea. So this is the big announcement that we are going to start the final marathon sessions. We are going to start the final marathon sessions from 5th June onwards. So tomorrow you have a session, and after that your marathon sessions are starting basically. So from 5th June. So this is it for today. Thank you everyone for joining the session, and I hope you understood the points. If there is any confusion, kindly ask in the comment section below, and let's meet in the marathon session now on 6th of June. So now the Finance 360-degree sessions will not happen because of your marathon sessions that will be conducted till your examination. So the Finance 360 will restart from 13th June now, like after 13th June for your phase 2. So instead of Finance 360, whatever different topics that we have to discuss, we will discuss it through the